Hi there, it's Malcolm, and today we're now going to be talking about remortgaging. So I suppose one of the big reasons that people come to remortgage is just simply to get a better rate of interest, isn't it?
Absolutely. You might be coming to the end of your existing deal, and you want to see what's available, and can you beat what you've got, or certainly can you beat the standard variable rate that you're going to go on to if you don't do anything.
And I think with people are getting used to sort of switching products from your car insurance and home insurance every year. I suppose switching your mortgage, unfortunately, is not quite as easy as a few clicks, because to change lender, they've got to assess you as a brand new applicant, so it does take longer.
It does. There are definitely more hoops to go through. There's a bit of legal work involved, obviously, because there's a legal mortgage deed that secures the loan to your property, and you need a new one. But the rewards, generally speaking, are worth it. I often say, well, why would you just want to sit on the standard rate? You probably wouldn't sit on the highest rate that your electric company are charging you. So why do you want to do that with what your biggest debt is? Your mortgage.
It's so interesting, isn't it? Because some customers will swap through gas or electric to save £10 or £20 a month, and can save £100 or £200 a month by changing the lender. But we still come across customers just sitting there on standard variable rate. And why do you think that still is?
I think it is just that inertia. For a start, they don't think about it. I think
I can still afford it.
I can afford it, yeah. So why worry? I think that, as you said, historically, if you go back a long time, it wasn't an easy thing to do. When I first started, remortgaging was almost a dirty word. You remortgaged and paid extra for the privilege, and typically it was only people who were in trouble and needed, to maybe raise capital for debt consolidation or whatever. And the lenders back then used to actually charge you more. And it was only when the market started becoming more competitive and lenders were starting to compete against each other that thought, hang on a minute, we could pinch their clients, and so they started offering attractive deals to switch. For me, the only reason why anybody who is sitting on standard variable rate, I would say there's only really one reason that I would do that, and that is if you know that you're going to be selling it fairly quickly and you want to keep your options open if you're going to be moving to a different property, then fair enough. And maybe if you know that you've got a large sum of money coming and you know that you're going to be in a position where you might want to make a big capital reduction, then that might be a reason for sitting on it. But other than that, you'd be better off looking at actually saving yourself some money.
And your existing lender may or may not offer you a product transfer mortgage to stay with them. Why don't lenders just automatically put a customer on a new 2-year fixed rate when their 2-year fixed rate comes to its end? I
think there's a technical reason, which is, I guess, that they can't change your terms and conditions without you agreeing to that. When you come to the end of the deal, it was already written in your terms and conditions that if you did nothing, you'll go on to standard variable rates. They've not changed anything at that point. That's what you agreed to in the first place. So if they wanted to change you onto something else, they need your agreement. There is another practical thing as well, and this is where I would always say, even if you think you might do a product transfer, it's worth taking advice on, because what product are you going to switch to? They might have a 2-year fixed rate. They might have a tracker mortgage. They might have a 5-year fixed rate. Which product are you going to take? Which is the right product for you? As advisors, we would look at that and not only work out which is the right product, but also, actually, did you know that there are better products than that available from another lender?
And what's the impact of a customer getting a message through from their lender and deciding just to hook into one of those new deals without taking advice from ourselves or without even taking advice from a bank? What kind of pitfalls would they expect?
Well, for example, they might tie themselves into something with early repayment charges that they'd overlooked, and if they then moved later on down the line, it could incur a penalty that they'd not foreseen. With us as advisors, obviously we're regulated, as you know only too well, and we have to justify why that is the right thing for you to do. So the one thing that we can say is if the product transfer is the right thing for you to do, we will recommend it. If it's not and there is a better option for you, we'll recommend that. But ultimately, you've then got, we are then bound by that recommendation. And if you then discovered that there was something why any advisor had given you bad advice, you've got recourse to ombudsman and so on.
Okay. Some people take the opportunity when the remortgage is due to raise capital. What kind of reasons typically do people look to raise capital against their property when they're remortgaging?
All sorts. It could be that they want to do some home improvements. Often it might be, especially if you've been on a product that was on a higher rate, you often find that we could get those home improvements done and get a lower rate, and we don't even end up paying any more each month. So it could be home improvements. It could be things like helping your children towards deposit on the property, or covering something like that. Sometimes it might be debt consolidation. Obviously, there are things that we would need to look out around that, but there could be all those reasons.
Okay. So there's some legal work, like you mentioned, because we're taking off the first lender's legal charge and replacing it with the new lender's legal charge. When you swap lenders, it tends to be that you'll get some cash back from the lender to pay for that work. So essentially, that legal work comes as free. However, there could be some additional legal fees to pay if you're adding someone onto your mortgage or taking someone off. So, for example, if a couple separates, Wayne, then all those things get sorted at the point of the remortgage as well.
Yeah, that's right. And basically anything that is going to change the legal ownership of the property, as you say, if you are divorcing or if you've got a new partner and you want to add your new partner on, that's going to change the legal ownership. So anything like that would typically incur additional legal fees. Whereas if it's just, two partners on a mortgage with lender A and they just want to switch to the two partners on a mortgage with lender B, then there typically wouldn't be any extra legal work. And usually your cashback would cover the cost of that. Fairly
straightforward.
Yeah.
Now, we do find that customers sometimes leave it a bit too late before applying for a remortgage, and that's one of the other ways that you can end up almost by default on the lender's standard variable rate. So you might be surprised that you can actually apply for a new deal and get locked into it well in advance of your current deal coming to its end.
Yeah, a product transfer typically maybe 3 months before your deal comes to an end, the lenders would probably allow you to switch. And as I say, if that's the right thing, that's what we'd recommend. Or it could be that if you apply early enough, most of the new lenders will give you a mortgage offer that would last at least 3 months, and most of them nowadays have extended that to 6 months. So, well in advance of your deal coming to an end, you ought to be looking at it and getting the application sorted so that as soon as your current product finishes, you're in position to switch to your new arrangement.
Yeah, well in advance, and that protects you in an environment where interest rates are going up. You can lock into that deal kind of sort of much earlier. You always have a strange kind of crossover month when your remortgage happens, because your mortgage payment is usually payable on the first of a month. So you'll pay your mortgage payment to your current lender, and then if you completed, let's say, on the 10th of the month for your new mortgage, you get to a situation where you were your first lender 10 days interest and the last 21 days with a new lender. So it's a bit messy, but don't worry if that happens, because lender A will refund you the mortgage interest that you've overpaid in that example there. So look, there's loads of reasons why it's a good idea to remortgage. You shouldn't ever end up paying a standard rate of interest in 99% of cases. What we like to do here is build up an ongoing relationship with all our clients, so that we're not getting just the best deal at the outset of the mortgage, but you stay on the best deal that's available to you right the way through the term, and that can save you thousands of pounds worth of mortgage interest. Thanks for watching. If you're in the market for mortgage advice, please drop me an email, malcolm@ukmoneyman.com, or give us a call, and please subscribe to our channel.